Coming up, Fed Governor Waller says the central bank could cut rates as early as July, citing that if you're starting to worry about the downside risk to the labor market, move now. Don't wait. However, most Fed policymakers still prefer a wait-and-see approach, with market pricing indicating the next rate cut won't come until September. And Iran says no nuclear talks will happen under fire. Sources say Qatar met energy majors. And we're seeing all sorts of volatility here this morning. Take a look around the room with me at the S&P 500, which popped back and then has dropped now again. Same thing with the NASDAQ, the Russell, and of course the Dow Jones. I do see a sharp bounce in the price of gold and the dollar here this morning, signaling risk on. Yes, these two things can move together, and typically it happens in geopolitical risk events. Bitcoin is sharply lower here now, and oil prices are stabilizing around the $75 price mark. And breaking news as I record this video, the US prepares action targeting allies' chip plants in China. The move isn't meant to escalate trade tensions, according to the White House officials. However, people familiar with the matter say that this could inflame trade tensions. A U.S. official told top global semiconductor makers he wanted to revoke waivers they have used to access American technology in China. Of course, chip makers like Nvidia, Taiwan Semiconductor, and AMD are also sharply lower on this news. And of course, anything that threatens the crown jewel of this stock market, which is the AI story, definitely can cause some big moves. And we know chips are very important to the global stage, as the AI race is well happening between the U.S. and other major countries, specifically China. However, stocks have been moving really well to the upside here recently in the last few months, but we've really stagnated in the last few weeks. We've really gone sideways. On one hand, you have some positives like inflation cooling. It does look like the Fed is likely to cut interest rates this year. However, some negatives have been the uncertainty happening in the Middle East, and at the same time, some hawkish comments from Jerome Powell in his recent meeting. And another thing I think is really interesting and may be a signal that a dip in the price of the stock market may actually be a buying opportunity in my view, is the recent spike higher in the put to call ratio, which we talk about frequently on this channel anytime this thing kind of gets very spooked or there's a huge demand for put contracts in the options market. To me, that's a signal to, if the conditions are right, potentially find some long side trades to go against the crowd sentiment. Speaking of crowd sentiment, take a look at the AAII Investor Sentiment Survey, which came out more bearish than bullish in the past reported week. You can see 41% of investors or traders saying they feel bearish on the stock market, 25% say they're neutral, and just 33% say they feel positive. Now, just for context, historically, this thing leans bullish, as most of the time investors are feeling more optimistic than pessimistic when it comes to long-term stock outlooks. But in recent months, we have seen very high levels of negativity in the stock market. And by the way, that high level of stock market negativity has been a very solid signal of wonderful buying opportunities in the last several months. So I'll keep an eye on sentiment to see if this thing continues to worsen as a potential contrarian long-term bullish signal. The Bitcoin to gold ratio also is looking pretty interesting. We typically call this risk on when the market is seeing a stronger demand for Bitcoin over gold, and more risk off when the market is demanding more gold over Bitcoin. And so we're sitting right in the middle right now. So we'll have to see if we get a more decisive move one way or the other to give us more clear indication as to whether or not we are more in a risk on or risk off environment. And I think that's pretty indicative of where we are. The market, it's very choppy. It's very indecisive. Just take a look, for example, at the dollar index. The dollar index has been chopping sideways for weeks now here and has been like watching paint dry, trying to figure out the direction of the dollar. It's been back and forth and largely not making a decisive move one way or the other. But in terms of the economic heat map, which compares a ton of economic data out of the United States, most of our indicators are suggesting some weakness for the US dollar. And when we compare this to the other 7 major currencies on this list, the US dollar is getting one of our weakest scores in terms of its recent economic surprise meter. This takes a look at all of the different economic data and says, is the US outperforming or underperforming expectations compared to its peers? Things like New Zealand, the Canadian dollar, the euro, those three look strong compared to the US dollar at this time. Our overall average here sitting at about 52% with our brand new indicator, the economic surprise score. By the way, if you're interested in trying out the Edge Finder, there will be a link in the description down below and in the pinned comments section to where you can try it out for 30 days. And if you'd like some information about that, simply fill out that link and submit that form, and we'll review your application for a potential trial of our tool. Taking a look at the euro dollar, I do tend to favor the upside move here, but I'd like to see either a break and retest, just a little bit more decisiveness, or even just a pullback down to this 1.14 level. I like the upside moves potentially for both scenarios there. The pound dollar, I'm a little bit more neutral on than the euro. I do like the euro a little bit more than the pound at this time. Dollar yen also looks really choppy here, and I don't have a strong bias on this one. Dollar Swiss does tend to trend. Dollar Swiss does look like it's still trending to the downside here and looks a lot like the DXY itself. I'd probably be bearish if we were to see a break through these lows. Dollar CAD is a currency pair that I'm really watching close. I do like the idea of potentially getting short around this 1.38 level if we do see price continue to push up into that zone. And if you're a US trader wondering what Forex broker I use personally, my go-to broker when trading currencies is OANDA. If you'd like to check out the special offer available to my subscribers by OANDA, check out the link in the description down below. They offer some pretty generous perks to people interested in signing up with their platform. I've used them for years. I love all of the different tools that you get as being a member with OANDA. It is a fantastic set of resources that they grant you. They have all sorts of like indicators, expert advisors, and all sorts of cool, powerful tools that come for free to OANDA clients that sign up. So if you're interested, make sure to use the link down below in the description for those special perks, those special sign-up offers that they're doing for my subscribers at this time. And taking a closer look at our current setups in terms of the Edgefinder's currency selection list, we can see that we have NZD-JPY on the bullish side, which I already have a long position on, Swiss yen, euro dollar, CAD yen, euro Aussie. So interestingly, seeing a couple yen crosses on the bullish side. Now, of course, that would be bearish the yen, bullish the counter currency, in this case, euro, Swiss, or CAD. And then we have some bearish setups on pound, New Zealand, and Aussie Swiss. And CAD yen looks primed for a potential bigger move higher here. We've been in this consolidation for a little bit and now trying to push beyond this level. Looks really interesting. We had the breakout pullback. I actually really like this currency pair to the upside, and I could see a move up to 110 potentially being in the cards, especially if you get a more risk on environment in the next few weeks. Oil prices are still sitting at this longer term level of resistance around the 75 round number play. I do think that there's a potential for us to pull back, especially if you get any sort of constructive positive news out of the Middle East. And from a humanitarian standpoint, fingers crossed that we do get some negotiations and some peace resolutions. And of course, loss of life is something that we always hope and pray against on this channel. So I'm hoping that we do get some positive resolutions over the weekend. And I am hoping too that could lead to a bigger pullback in the price of oil. I am still bullish on oil. I like the idea of adding some exposure to energy stocks in my portfolio, but also trading the commodity on the long side if we do get some pullbacks. Not necessarily because I think that the geopolitical conflict is going to continue, but rather because I think the global economy has the potential to hold up a little bit better than people think it will with all the tariff worries and things like that. And oil prices, in my opinion, could actually see further demand driving upside from here. But from a geopolitical standpoint, I would love to see some resolutions and some compromises happening in order to get oil prices to push lower. Another reason that I can't justify going long oil at these levels is because take a look at our put to call ratio selecting for oil specifically. You can see that we are hovering in the extreme greed category, or an area where essentially the options market is showing us there's a ton of demand for call options in the options market. So the crowd thinks oil prices are going to continue to explode higher. Maybe they'll be right. Let's hope, like I said, from a humanitarian standpoint, that they are incorrect about that, because likely a rise in oil prices would come at the cost of destruction and scary stuff happening in the Middle East. Speaking of another beneficiary to geopolitical unrest, we have gold here sitting just shy of its all-time high, big level of resistance around this 34.25 area. I'm interested in adding some gold from a hedging perspective and from just I think it has potential upside perspective around 3,300, or a breakout and retest into this same 34.25 level. If we can overcome that area, I would take that as a bullish signal, but I also like the fundamentals. Our gold scanner here is giving it a very bullish reading with COT data, retail sentiment, seasonality, and trend suggesting some upside. And then most of our economic readings suggesting some cooling off in the US economy, which could weaken the dollar and strengthen gold's case. In today's Market Insights podcast, I spoke with Johnny Hart a little bit more about the Fed Waller comments that happened this morning, as well as what's happening in the Middle East. Stay tuned and check out this clip if you'd like to see the full episode. Use the link in the description down below to watch that full episode there.
Yesterday was an incredibly busy day, wasn't it, with all the reaction to the US Fed, the Bank of England, the Swiss National Bank, the geopolitical, and so on. And in fact, talking of the Fed, we had some comments earlier today from Christopher Waller, who's on the Fed Board of Governors, which has given an encouraging sign to markets that perhaps we're going to see an interest rate cut sooner rather than later. What did Mr. Waller have to say?
Yeah, so the circumstance with the Fed right now, Johnny, as we know from the comments made by Jerome Powell on Wednesday, he came across pretty hawkish. But we saw some of the internal voting mechanisms at the Fed in regards to the dot plot, and there is some doves amongst the crowd there. It is not a uniform decision of, hey, we need to hold rates steady. There's mixed thoughts on this, and in fact, I think in the economics community, there's been a rise dramatically in the call for rate cuts. I think that there is, clearly based on our conversation yesterday, I've added myself, I suppose, to that team a little bit more, pushing for the rate cut side of things. However, Waller, to just put a little bit of take a grain of salt, Waller tends to be one of the more dovish members of the Fed. He has been for some time, but it doesn't change the fact that this is an important role that he holds within the team there at the Fed, and he not only has a role, but he also has influence. And so there is this, like I said, this rising kind of, hey. There's both the stag and the inflation concerns. We've talked about that a lot in recent episodes. But this concept of you have the committee or the members that are more like Powell, who are a bit more on the, hey, we need to really be sure that inflation's done before we cut rates. But then there's a rising subsect of colleagues, I suppose, that are more on we're seeing evidence of rising unemployment statistics. Specifically, Waller mentioned that he saw a rising unemployment in recent graduate students, which is an interesting indicator that he brought to the attention. Of course, these Fed officials, they might just be showing off how much data they have in front of them. But I thought that was an interesting point, and perhaps just indicative of the rising unemployment concerns. There's not a huge spike in unemployment yet, but we know how these things can behave. They can be all of a sudden at once. We get a surge in labor statistics, and there's a rising concern of why would you risk this when inflation is mostly looking pretty good. Sure, you have the uncertainties ahead, but isn't the Fed supposed to be data dependent, right? If we're being data dependent, we shouldn't be making big forecasts on what tariffs we're going to do, just like the Fed got in trouble for doing the mistake in 2021 of making the prediction that inflation was going to be transitory following the COVID pandemic, right? So I think a lot of the economics community is saying, hey, are we being data dependent, or are we trying to make a forecast on how inflationary tariffs could potentially be?
Interesting, that point about the students, though. It just shows you that the devil is sometimes in the detail and the minutiae. One thought on unemployment. I was watching the press conference yesterday from the White House, and Caroline Leavitt was talking about the numbers that have been cut in terms of illegal migration. And one does wonder, actually, if the United States has shut down the border to that extent, and there is no illegal migration at the moment, that there will be an employment gap that's going to have to be filled. And it's something to bear in mind for the future in terms of jobs, particularly in things like the farming community. But I digress slightly, but I thought it was an interesting point.
I think so too, and I think that it kind of opens up another side of this conversation, which is, in my view, another suggestion that a rate cut could be appropriate, which is this idea that, okay, you have, yes, the concerns about tariffs could cause inflation, but let's take the other side of that and say, what if these rising tariffs don't necessarily cause a tremendous inflation problem, but what if they do cause an economic slowdown and you held rates too long, which worsens the problem? And in your case, maybe the unemployment gap there or the missing labor supply there could even further extrapolate the problem. So it's almost like a preemptive cut when inflation is looking okay. Seems to be a rising popular thought, and I'm very curious to see if in the upcoming meeting where what we heard from Waller today, the suggestion that is a potential option in July. I wonder if the tone changes between now and then, or if Jerome Powell is going to strongly stick to his guns on this. And today I had a really interesting conversation on our live stream about who the real winner in the big sell-off in the NASDAQ and the S&P 500 actually truly was. And I want you to stick around and listen to this because it might surprise you who seemingly did pretty well in all of the market sell-off. Check this out. I went to a dinner event yesterday and talked to someone there who had an awesome story. He essentially... we had spoken months back, just hanging out, and we talked a little bit about, what I do, right? The trading and investing and stuff like that. Well, he mentioned that he actually he works at a private equity firm, and everybody in the private equity world that he was working at was terrified during this time. And he personally told me that he bought a bunch of stuff, and he even bought some like call options on stocks that he liked. And he said that he has done phenomenally since that period. Now, the reason I bring that up is that I think it tells the story of what we saw happen in the March and April sell-off. Now, I am not going to act like everyone made money during this time. It was, for a lot of people, it was a really devastating period of time, and I get that. But on average, the winner in all this might surprise you. The winner in all this was actually the retail trader. There was a whole bunch of reporting data that there was big inflows into stocks at the brokerage houses. Robinhood, they and these various brokerages put out data on the retail clients that they have, and they bought the dip. Meanwhile, you know who sold? Private equity firms, hedge funds, pension funds, wealth management groups. Because I want to talk about why that is. Why did the retail trader just win big in this? And again, not everybody did. I'm just saying on average, the data flows suggested that retail, the crowd, bought the heck out of the dip and actually did really well in all this in terms of the stock market. Now, the reason is, I think, is because hedge funds and pension funds and private equity and all these firms and businesses that do this professionally, they can't be taking crazy risk. When you have tariff announcements and you have, hey, everything looks terrible and this could completely disrupt everything. For valuations, we could enter into a multi-year recession. All those things start to flare up at once. Institutions, they don't play that game. They're managing people's money. They have this responsibility of being like, I need to shut out and close down and de-risk and get out of the way of what might be coming. Retail traders don't have that financial responsibility. Now, that can hurt them because sometimes they make stupid decisions, but they don't have the obligation to de-risk when markets start to panic. And where that favors the retail traders is one of the biggest edges that I think retail traders have, is that when you get these massive sell-off, capitulation, doomsday events, retail traders have the ability to say, I can take some calculated risk here. Whereas many hedge funds have obligations when they're managing other people's money. They do not want to get caught blowing up client money. So they have to de-risk. And so there's a huge advantage here to the retail trader, who this fundamentally I do not see changing. This is why when it comes to sharp market dips, I almost always find stuff to buy. Now, I don't buy everything. I buy specific stocks and indices and look for trades that I like, that I think have great potential. I'm still selective. I'm not an idiot with it. But I think calculated risk during these times is a massive edge, a massive advantage that the retail trader over the last multiple years has had the luxury of being able to do that financial professionals do not have the luxury of doing. The wealth management groups, all those groups, right? They have to protect risk. When it comes to the average investor, the average trader, the weekly inflows were incredible, right? So there was this huge surge in retail buying the dip. They were buying stocks like Tesla. They were buying stocks like Nvidia, right? Buying stocks like Meta. The crowd, the little guy, actually did the best in this recent sell-off. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.